I think the fears were not justified, and it's a very compelling situation. Stock's still cheap. 40% rally this year is barely a drop in the bucket. And that's how I want you to think it. I think it's also a good example of why these bounce back moves might be far from over. These stocks could have more room to run.
And it's gone.
Should I be worried about Bear Stearns in terms of liquidity and get my money out of there? No, no, no. Bear Stearns is fine. Do not take your money out. This is real. Look, if there's one takeaway other than a plus 400 somewhere, Bear Stearns is not in trouble. I mean, if anything, they're more likely to be taken over.
And it's gone.
Guys, today the FDIC closed down Silicon Valley Bank and put it into receivership. So, how did this happen to the 18th largest bank in the US? And more importantly, are other banks at risk for the same reasons? Well, the short answer is yes. So let's start with how this happened. And to put it simply, SVB had a huge increase in deposits from about 60 billion at the end of 2019 to about 189 billion by the end of 2021. As their deposits grew, they could not loan the money out fast enough to generate the yield they wanted, so they put over $80 billion of that into mortgage-backed securities with 10 plus years of duration, which were only yielding about 1.5%. When interest rates started rising, that dropped the value of those bonds significantly. And normally that would not be a big problem because they expected to hold these bonds to maturity, so they would get back the full principal. But if they had to sell them prematurely, they would be hit with a big loss. Well, deposits started to drop, possibly because of the risky startups that they lend to were running low on cash, or possibly because many people in Silicon Valley started getting laid off and needed access to cash in their SVB accounts. So to try to raise some cash, SVB announced that they had sold about 21 billion of their AFS, that's available for sale securities, and took about a $1.8 billion loss on that. Now that loss was on their shorter term stuff. Their longer term stuff still has about a $16 billion mark-to-market loss on that, meaning that's what they would lose if they sold off all of those long-term mortgage-backed securities. And to make matters worse, people started removing their deposits, and even Peter Thiel recommended that people and companies take their money out of SVB. So now if they wanted to raise deposits, they would have to borrow at around 5%, while they are only getting about 1.5% on all those previous deposits that they took and went and bought those long-term mortgage-backed securities with. Now, just so you understand how sensitive longer duration bonds are compared to shorter durations, let's do a quick calculation. So let's look at what happens to the price of their longer term bonds. Let's say they buy this at 100 face value. The annual coupon rate, call it 1.5%. The market rate at the time is 1.5% as well, and the years to maturity is 10. Right, so the duration is 9.3. The present value of the bond is $100 because that's what they paid for it, and the interest rates have not changed. But now a year later, your interest is still 1.5% on the bonds, but the market rate is 5%, and there's 9 years left to maturity. What's the price of this bond worth now? Only 74.88. So you lost about 25% off the value of this bond. And just to show you how much more sensitive duration is the longer the term, if we put a 30-year bond in here, everything being equal, your bond is now worth about $46. So you lost 54% of your bond. Now do the opposite, going only 1 year out to maturity. And how sensitive is that? Now you're only down about 3.4% on your bond. So you see, the longer you go out, the duration matters. It becomes very sensitive if interest rates change a lot, which they have in 1 year. This is the problem. And looking at this chart from the FDIC should really scare you because this is unrealized bank losses on securities as interest rates rise. And these are available for securities. The black and the orange is held to maturity securities. And so the losses between the two of them were very little, even back during the great financial crisis. But now that interest rates have moved so much, they have skyrocketed to about $700 billion in mark-to-market losses. And the majority of that is the stuff that the banks bought and intended to hold until maturity. That works until you have a problem and you have to sell it beforehand, and then you have to sell it at a discount, as you see, because of the longer duration. So the Zero Hedge article is asking, is SVB really unique, or who is next? And so they said the bank had $212 billion in assets, and $120 billion of those are securities. And so there's two categories: available for sale and hold to maturity. These, they expect that they're going to sell them before they mature, and there's 26 billion of that as of December 31st, 2022. But the hold to maturity securities, there was 91 billion of that at the end of 2022. And so these are the longer term things that have the long duration, that are very sensitive to interest rates. And these were bought around the time of the 1.5% interest on these bonds. So these things are taking a huge haircut right now. If you want to sell them, you're going to have to sell them at a discount. And so this is a look at SVB's assets: 108 billion in treasuries and agency bonds, only 15 billion in cash, 15 billion in other, and 74 billion in net loans. Now, SVB is not alone, because all banks buy treasuries, some shorter, some longer, and so they all dropped in value last year as the Fed's fastest rate hiking campaign since Volcker. But SVB was at an entirely new level. Their investment portfolio swelled to 57% of its total assets. And so no other bank among 74 major US banks had more than 42% of its total assets. So here you see CFR and State Street are at 42%, Bank of America is at 31%, USB 27%, Citigroup 23%, Wells Fargo 24%, JP Morgan 19%, and Goldman Sachs all the way at the bottom 8%. And so here's why SVB is different. Most lenders have very broad customer bases spread among individuals and companies, and thus their funding exposure was well diversified. SVB, on the other hand, grew rapidly thanks to its focus on tech startups as its primary clients. In the end, this is what would seal the company's fate after several prominent VCs, such as Peter Thiel and others, urged their portfolio companies to pull their funds, sparking a terminal bank run. And Morgan Stanley says the funding pressures facing SVB are highly idiosyncratic and should not be viewed as a read across to other regional banks. And that may be true up to an extent, but this is SVB's unrealized losses. They were very manageable up to 2022, and now they stand at about $16 billion. And so their unrealized losses divided by their total equity was fine at the end of 2021, but by September of 2022, it was minus 100%. So how do some of the big other banks stack up to those kinds of losses? Well, let's look at the big four net unrealized losses. And again, you see these numbers, even going back to the great financial crisis, are tiny compared to what they are just starting in 2022. So Bank of America has about $100 billion in unrealized losses, JP Morgan $36 billion, Citigroup $25 billion, and Wells Fargo about $41 billion. Now, all of those losses are bigger than SVB's $16 billion in losses, but when you look at it as unrealized losses divided by total equity, SVB is here at 100, Bank of America is a little bit above 40%, and then the rest tail off. Citigroup is, 17% or something along those lines. So not as bad as SVB, although Bank of America is something you might want to be a little concerned about. Now, if you look at the year-to-date returns of some of these regional banks down between 38 and 40%, then you'll see that a lot of investors do not think that this may be limited to just SVB as the problem. And so here's the chart that shows why the smaller banks are having bigger problems than the larger banks. Small bank reserves are as low as they are going to go, drying up as a source of funding for loans. And you see that in January of 2022, they were above 20%. Now they are like 2%. Whereas large banks, they were around above 25%. Now they are about 11 or 12%. So normally they say higher rates in sort of stable environment is good for banks in the long run, but it can be painful getting there. And so SVB misjudged how quickly the Fed would raise interest rates to contain runaway inflation. And at the height of the pandemic, as deposits soared and loan growth was scarce amid exuberance in venture markets, SVB joined rivals in loading up on mortgage-backed securities and other bonds in a hunt for better yielding assets. But banks like JP Morgan, which initially faced investor pushback when it didn't immediately plow excess deposits into securities, is now looking pretty smart. Now, SVB depositors should be okay, right? Because it had FDIC insurance, right? Yes and no. So this is a list of the percentage of total deposits in banks that have less than 250,000 in them, right? So the higher the ratio means the more accounts that had less than 250,000, the smaller accounts. So Northwest Bank shares as of the fourth quarter of 2022, 64.5% of the total deposits were in accounts under 250,000. All right, so Regions is 52, Capital One is 50, JP Morgan is 32. But all the way down here at the bottom, close to Citigroup, which is 15, is SVB, which is 2.7%. That means most of their deposits were in really big accounts, which brings us to this article. Expect mass layoffs, the real world impact of SVB's failure. That's because SVB was not just a dominant player in tech, but were highly integrated in some non-traditional ways. So the founders of companies were highly tied into SVB because it was not just their startups bank and the lender to them, but they also provided personal mortgages and other financial services. And so that means the uninsured balances at SVB, those above 250,000, are in jeopardy because the FDIC plans to pay them out as it sells the assets of SVB. And because lots of startups banked with SVB, because this was a covenant of their debt. In other words, you want to borrow money from us, you have to bank with us and keep all your funds with us. So the CEOs of these startups had to face a hard choice. You can either pull your deposits and go into default because you break the covenant of your loans from SVB, or risk losing everything if the bank failed. And so many chose to hold tight as SVB's outright failure seemed outlandish. Now they may not be able to make payroll next week. And so this is where the layoffs come in. Expect mass layoffs later today, Monday at the latest. So if you want to see what a bank shutdown looks like, here the FDIC says Silicon Bank was closed by California Department, blah, blah, blah. To protect insured depositors, FDIC created the Deposit Insurance National Bank of Santa Clara, DINB. At the time of closing, the FDIC as receiver immediately transferred to the DINB all insured deposits of Silicon Valley Bank. That sounds great, right? All insured depositors will have full access to their insured deposits no later than Monday morning, March 13th. The FDIC will pay uninsured depositors an advance dividend within the next week. Uninsured depositors will receive a receivership certificate for the remaining amount of their uninsured funds. As the FDIC sells the assets of Silicon Valley Bank, the future dividend payments may be made to uninsured depositors. Not good. So, because of this, should you go run out and take your money out of banks? Not necessarily. If you have less than $250,000 per account, you should be okay. If you don't and you have more than that, maybe now's the time to think of a second or third bank account in another bank for the excesses above $250,000. Now, I don't want to cause panic, but if you want to know who owns your money once you deposit it into a bank, and if you want to know how much the FDIC actually has on hand to cover bank defaults, watch my video that I did a little while ago coming up next. Janet Yellen today said that she was keeping an eye on the situation with Silicon Valley Bank.
You mentioned Silicon Valley Bank. There are recent developments that concern a few banks that I'm monitoring very carefully.
Well, thank God for that. That makes me feel so much better, Jan. Where did I hear something like that before?
Our assessment is that there's not much indication at this point that subprime mortgage issues have spread into the broader mortgage market, which still seems to be healthy.
Remember, history doesn't repeat, but it rhymes.